a commodity and financial futures brokerage that had been founded in 1969, that had grown into one of the largest futures brokers in the world with approximately 400,000 customer accounts, that had completed a successful initial public offering in August 2005, raising approximately $580 million from public investors, was revealed in October 2005, approximately 60 days after its IPO, to have a specific hidden liability of approximately $430 million that its CEO had been concealing from auditors and investors by transferring the debt to a related party entity that he controlled at the end of each financial reporting period and then transferring it back at the beginning of the next period, in a specific pattern that had been maintained for at least several years. The company was Refco Incorporated. Its CEO was Philip Bennett, born in England, who had joined Refco in 1981 and risen to chief executive, leading the company through 2 decades of growth in commodity and financial futures brokerage before orchestrating both the company's 2005 IPO and the specific financial concealment that the IPO's due diligence process had apparently not detected. The specific liability Bennett was concealing was a debt owed to Refco by an entity he controlled, a debt that had arisen from specific bad trades and specific operational losses that Bennett had moved off Refco's own balance sheet to conceal from auditors, by structuring them as receivables owed by the related entity to Refco rather than as losses recognized by Refco directly. Morgan Housel has written that the specific corporate frauds most likely to occur in the period immediately following a major corporate financing event, an initial public offering, a significant acquisition, or a large debt issuance, are those in which the specific person responsible for the concealed liability has a specific personal financial incentive, related to the specific financing event, to ensure that the concealed liability is not discovered before the specific financing event generates the specific personal financial benefit the concealer is pursuing. Bennett's specific personal financial benefit from the Refco IPO was substantial. He held a large personal equity stake in Refco whose specific value was directly determined by the specific valuation at which the IPO priced, which was itself directly determined by the specific reported financial condition of the company whose most significant hidden liability he was concealing. Benjamin Graham's investment philosophy included a specific and repeatedly articulated principle that has particular relevance for evaluating companies immediately following significant corporate financing events. The specific principle that the specific timing of an investment opportunity matters as much as the specific valuation, and that investments made immediately following events that create specific personal financial incentives for management misrepresentation require specific additional scrutiny of precisely those financial statement elements whose misrepresentation most benefits the specific managers who would bear the most direct personal financial cost of accurate disclosure. Daniel Kahneman's research into how the specific structure of an auditing engagement, in which auditors are engaged and paid by the company they are auditing, creating specific conflicts of interest between the auditor's professional independence and the auditor's commercial relationship with the client, is relevant to understanding how Bennett's specific concealment survived the specific due diligence process associated with the Refco IPO. The specific concealment mechanism Bennett used, transferring the liability to a related entity at each period end and then returning it at each period's beginning, was specifically designed to be invisible to auditors examining the company's financial statements at standard period end dates, because at those specific dates the specific liability was not on Refco's specific balance sheet. The specific detection of such a mechanism requires not just standard period end audit procedures but specific procedures designed to detect exactly this kind of round-trip transaction, procedures that the specific standard audit engagement apparently did not include. The specific timeline of Refco's IPO and collapse illustrates with unusual clarity the specific speed at which confidence in a financial institution can be destroyed by a specific credibility-destroying disclosure. The IPO priced in August 2005. In October 2005, an anonymous source provided specific information about the Bennett liability to Refco's board, which disclosed it publicly. Within approximately 1 week of the disclosure, Refco's stock price collapsed, its customers began withdrawing assets, and its ability to operate as a going concern ended. The specific rapidity of the collapse was not surprising. A futures brokerage whose specific commercial function depends on customer confidence that their specific assets are held by a specific solvent and honest counterparty has no specific commercial function if the specific honesty of its management is publicly and credibly called into question. Robert Kiyosaki's core lesson about understanding the specific financial structure and the specific management integrity of any institution in which you place your assets, and specifically about the particular fragility of financial institutions whose specific commercial function depends on the specific trust of their specific customers in the specific honesty and specific solvency of the specific institution, applies to the Refco situation with the particular urgency that the specific speed of its collapse illustrates. The 400,000 customers who held accounts at Refco at the time of the disclosure did not have a specific extended period in which to evaluate the specific implications of the disclosure and make a specific considered decision about whether to withdraw their assets. The specific market dynamics of a financial institution whose specific trustworthiness is publicly called into question effectively required a specific immediate response or a specific acceptance of the specific risk that a delayed response implied. Here's an honest complication worth including. The specific customer consequences of Refco's collapse were significantly less catastrophic than the initial weeks of the bankruptcy suggested they would be. The specific segregated customer accounts at Refco's regulated futures brokerage subsidiary were, unlike the experience of MF Global a decade later, substantially intact and eventually returned to their specific owners through the specific bankruptcy process. The specific harm was primarily to equity investors who had purchased Refco stock in or after the IPO, to specific creditors of the holding company entities, and to specific employees. The specific mechanism of customer protection through segregated account requirements in regulated futures brokerage worked in the Refco case in a way that it did not work in the MF Global case, a specific difference whose specific implications for the specific regulatory frameworks governing futures customer account protection are instructive. George S. Claessen's fundamental advice about the specific importance of building every specific commercial enterprise on a foundation of specific, genuine honesty in all specific commercial relationships, and about the specific long-term fragility of any specific commercial enterprise whose specific apparent prosperity is built on specific concealment rather than specific genuine performance, describes both the specific founding of the Bennett concealment and its specific eventual exposure, with a precision that makes the specific ancient Babylonian wisdom feel directly applicable to the specific modern financial institution. So here's a question worth sitting with. In your own investment practice, do you specifically evaluate the specific management integrity of any company you invest in through any means beyond reviewing its specifically audited financial statements? And if so, what specific additional verification methods do you apply? And what specific red flags do you consider most reliable indicators of the specific management integrity risk you are most concerned about? Before you leave, I want to hear from you. Have you ever made a significant investment in a company specifically shortly after a major financing event, an IPO, a major acquisition, a significant capital raise? And did the specific timing of your investment relative to that specific financing event affect how carefully you evaluated the specific financial statements that the specific financing event had most directly motivated management to present favorably? Read a few comments before you go. Some of the most practically important insights on this channel come from people who've thought carefully about exactly that specific timing question in their own investment history. Next week, I'll pick one comment and send its author one of the books that inspired this channel. And if these stories help you think differently about money, you'll find a way to support future research in the description. Every contribution helps buy books, access research, and keep this content free for everyone. Remember this. Revco did not collapse 60 days after its IPO because the specific commodity brokerage business it operated was fraudulent, or because its 400,000 customers had placed their assets with an institution that had no genuine commercial value. It collapsed 60 days after its IPO because the specific CEO who had led it to the specific IPO that created his specific personal financial benefit had been concealing the specific liability whose disclosure destroyed the specific institutional trust on which the specific commercial function of a futures brokerage specifically depends.